Okay, good morning friends. We are on lecture number 2 of our version 4 batch of CA Final SCM and PE. If you remember in the last lecture, that is first lecture, I had discussed about myself, the subject, the way of teaching, and then we had gone through the basic concepts, cost concepts. That is a quick revision of CA intermediate. That is what we had done in the earlier lecture. Now today I'll take you to chapter number 6, that is decision making. Decision making, also known as marginal costing, also known as CVP analysis, that is cost, volume, profit analysis. So I'm starting with chapter number 6. I'll take you to the very basics also. I'll quickly revise the intermediate concepts. We will solve few basic questions also, just for revision purpose, not final level question, intermediate level questions, few questions we'll solve. And then slowly we'll move to decision making situations. Variety of decision making situations we'll deal with, which a businessman has to face or the management of a company has to face, and they have to take variety of business decisions. So those will start slowly. But today we'll go through the basic formulas of CVP analysis, that is marginal costing, and then onwards. If you want, you may open the page of your notes if you want to, right? I will also put it on the screen. Right friends, this is our chapter number 6, decision making. As I told you, it is also known as CVP analysis, that is cost, volume, profit analysis. See, it's written here, cost, volume, profit analysis. Some people call it as BP analysis also, that is break even point analysis. All this you will be able to remember from your intermediate background. Okay, my dear friends. So I'll take the help of my PPT presentation and I'll take you through. Right friends, let's begin. Marginal costing, which is a technique used for decision making. So it's a technique. We had seen 3 techniques: marginal costing, standard costing, budgetary control, out of which marginal costing technique is used for the purpose of decision making. So this is a popular technique for managerial decision making, and that is the name of our chapter. Actually chapter number 6 is named as decision making. But to take the business decision, the technique on which we rely, that a technique is called marginal costing or CVP analysis. So it's a tool or it's a technique which will help management in taking business decisions. Now this technique of marginal costing or CVP analysis, this technique recognizes only 2 types of cost. That is one of the limitation of marginal costing also. It recognizes only 2 types of cost. It means all the cost incurred in the business are divided in 2 parts. Either it should be classified as variable cost or it should be classified as fixed cost. So either variable or fixed. And all of you are aware, variable cost is one which varies with the level of activity, that is with the level of production. If your production number of units produced goes up, the cost goes up, then it is variable cost. And irrespective of number of units produced, if the cost remains constant, it means whether you produce less, you produce more, or you don't produce, if the cost is remaining same, that is fixed, constant, then it becomes fixed cost. So marginal costing divides all the cost in 2 parts, either variable cost and fixed cost. That is one of the fundamental assumptions of marginal costing also, and one of the limitations also. Because later on, once we move to little higher level question, we'll see that if a particular cost is not exactly divisible into 2 parts, it means if a particular cost is neither variable, nor completely variable, nor completely fixed, then what is to be done? So this type of situation also we will deal with later on, don't worry. But for the time being, for our basic discussion purpose, you will assume that cost can be divided in 2 parts, variable and fixed. Now, if there is a semi-variable cost, then what is to be done? We say it is semi-variable cost is partly variable, partly fixed cost. So if there is a semi-variable cost, then you need to subdivide it in 2 parts. Semi-variable cost has to be splitted into 2 parts, that is variable portion and fixed portion separately. So finally at the end, cost will remain only of 2 types under marginal costing technique, that is either variable cost or fixed cost. Now how to split the semi-variable cost in 2 parts, that also we will see while solving the question. we will use the differential formulas. If you can remember the differential formulas by which we can split the cost into variable portion and fixed portion. Variable cost is also known as product cost. Very important. Variable cost is also known as product cost. My dear friends, if out of this you want to write anything, that is your choice. Out of my presentation, if you want to take down anything in your notebook, you may do so. That's your choice. Okay. Now, variable cost has an alternative name called product cost, and fixed cost has an alternative name. It is called as period cost. Now, let us spend some time because this is very, very important. Variable cost is known as product cost because it varies along with product. It means number of units produced. If you produce more, cost is more. If you produce less, the cost is less. Such type of behavior is called behavior of variable cost. As the cost is dependent on production or number of units produced, variable cost is also known as product cost. Are you getting it? And fixed cost is known as period cost because this cost changes according to time period and not according to number of units produced. So the cost which changes or behaves depending upon the time period is called period cost, that is fixed cost. For example, if I have to pay rent, factory rent at the rate of rupees 5 lakh per month, then this 5 lakh rupees cost is attached to a month, means to a period, time period of 1 month. For 12 months, that is for a year, I'll have to pay 5 lakh into 12, that is 60 lakh rupees. It means this cost is dependent upon the time period for which I hire the premises. It is not dependent upon how many units I have produced in the factory. Are you getting it? So this rent is one of the example. So rent cost is not dependent on units produced, but it is dependent on time period. Therefore, it is called period cost, and we call such cost as fixed cost. So fixed cost has an alternative name. It is known as period cost, that is time based cost, and variable cost has an alternative name which is called as product cost. Now we'll see the behavior of these two costs, how the variable cost behaves and how the fixed cost behaves. Before that, I'll go to division of cost connecting with the yesterday's lecture. If you remember, in the first lecture, I had divided total cost in two parts, and we had seen the cost sheet also, if you remember. And these two parts were prime cost and overheads, if you remember. This is the normal classification of cost. Prime cost is direct cost, overheads is indirect cost. Prime cost consists of direct material, direct labor and direct expenses. I hope you remember this, right? Direct material plus direct labor plus direct expenses is your prime cost. And overheads consists of indirect material plus indirect labor plus indirect expenses. This is something basics we are revising, which you have studied in intermediate, I suppose. Okay, so everything should get revised. You are not studying it for the first time. Now this classification, prime cost and overheads cost classification, is popularly used for preparation of cost sheet, that is for accounting purposes. However, our purpose is decision making. Here, our chapter, the name of the chapter itself is decision making. For decision making, and that is for marginal costing, we need the two types of cost, which is variable cost and fixed cost. So I want to convert this cost, which is used for cost sheet purpose, into decision making cost. That is for CVP analysis, that is variable cost and fixed cost. Now please remember, prime cost being a direct cost, it is prime cost is prime cost of production, if you remember. It is directly associated with number of units produced. One-to-one association is there, therefore it is called direct cost. And overheads cost, you know, it is also called as indirect cost. Overhead cost is a common cost which doesn't have one-to-one relationship with number of units produced. Now why I am saying so? Prime cost being direct cost is always variable. I repeat, prime cost being direct cost is always variable. So in the question, if they tell you direct material, what type of cost it is? Variable by default. If they give you direct labor cost, by default it is variable. If they give you direct expenses, by default it is variable. All prime cost by default are variable cost. Now only overhead cost you have to divide in two parts. for marginal costing purpose. Overhead cost we have to divide in two parts, that is variable overheads and fixed overheads. So overhead cost I will split in two parts, variable overheads and fixed overheads. If you remember, for cost sheet purpose we had divided or classified overheads in three parts. For cost sheet purpose, that was factory overheads, administration overheads and selling and distribution overheads. That we had done for cost sheet purpose. Now here for marginal costing purpose, I would like to classify overheads only in two parts, that is variable overheads and fixed overheads. It means these three overheads will go. For example, if in the question they have given you factory overheads, no problem. But I want, for marginal costing purpose, I want variable factory overheads and fixed factory overheads. Are you getting it? If they give you administration overheads in the question, no problem. But I want to know that out of administration overheads, how much is variable portion and how much is fixed portion. So overheads could be factory overheads, overheads could be administration overheads, overheads could be selling and distribution overheads. That is not a problem. But I want these three overheads to be further classified into variable overheads portion and fixed overheads portion for marginal costing or for CBP analysis. Now, this prime cost, as I said, is always variable. Prime cost plus variable overheads together will become variable cost. So this is our variable cost for marginal costing purpose. So how we'll get the variable cost? Prime cost by default variable, and out of total overheads you have to take only the variable portion of overheads. So prime cost plus variable overheads is variable cost and fixed overheads is fixed cost. In the question they may tell you fixed overheads, or the word used is fixed cost, both means one and the same, because prime cost is never fixed. So fixed overheads becomes your fixed cost and variable overheads plus prime cost together will become your variable cost. Is this clear? So we have to reclassify the cost which was used for cost sheet purpose into CVP analysis purpose. So same cost, prime cost and overheads is reclassified into variable cost and fixed cost. And now I'll take you to the behavior of cost. This behavior of cost is also known as CVP analysis. Behavior of cost is also known as CVP analysis. I am repeatedly saying whatever you wish to write in your notebook, you can take down always, right? That is your choice. Now this is cost volume profit analysis. CVP stands for cost volume profit analysis. Now let's understand this behavior of cost with change in production, because the behavior of cost is judged on the basis of whether the cost changes with change in production or not. So we'll see the behavior of variable cost, we'll see the behavior of fixed cost also. If you want, you may prepare this format. I am taking two types of variable cost. Variable cost per unit and variable cost total. And you have to see it very carefully. Though it is very simple, it is very basics, but you have to understand it very carefully. Otherwise, some silly mistakes take place here. Fixed cost also I am taking two types, per unit fixed cost and total fixed cost. Is that clear? The total variable cost divided by number of units produced, you will get per unit variable cost. Similarly, total fixed cost divided by number of units produced, you will get per unit fixed cost, or cost per unit multiplied by number of units, you will get total cost. It's one and the same. It's nothing great which I am telling or narrating you. Now let us see carefully the behavior of these four types of cost. Variable cost I am taking two types, per unit and total. Fixed cost I am taking two types, per unit fixed cost and total fixed cost. Now due to change in production, what happens? Suppose my production increases. So there is an increase in production. It means, let us assume earlier I was producing 10,000 units in a year. Now I have started producing 15,000 units in a year. So there is an increase in production. Now due to increase in production, what will happen to per unit variable cost? With increase in production, whether per unit variable cost will increase? So no, my dear friends, per unit cost remains constant. I repeat, variable cost per unit always remains constant. It is per unit cost. It means suppose to produce 1 unit, my variable cost is 50. So per unit will remain 50. Now you may tell me that, sir, you only said that variable cost varies with change in productions. That is correct, but that is total will change. Per unit 50 into number of units. If you produce more into number of units, the total cost will be higher. So which cost will increase? Total variable cost increases with increase in production. However, per unit variable cost always remains constant. Now we go to fixed cost. Just imagine the behavior of per unit fixed cost with increase in production. My dear friends, if you can carefully observe, per unit fixed cost will decrease with increase in production. Naturally, it will decrease. Per unit variable fixed cost will decrease. But total fixed cost will remain constant. If I take the same example of rent, our monthly rent was, let us say, I am taking another example, simple example. Monthly rent is 1 lakh. Monthly rent I am taking. 1 lakh rent divided by suppose 10,000 units. Just to take the simple figure. So 1 lakh divided by 10,000, you will get 10 per unit. But when my production increases to 15,000 units, but rent will remain 1 lakh, total rent will remain 1 lakh. Total fixed cost is constant. But same 1 lakh fixed cost divided by 15,000 units. My denominator is increasing, so cost per unit will decrease. So as total fixed cost remains constant, total fixed cost divided by number of units produced have gone up, so per unit burden of fixed cost will reduce. So per unit fixed cost decreases with increase in production. However, total fixed cost remains constant. Similarly, if I decrease my production, that is from 10,000 units, if I decrease my production to 5,000 units, then what will happen? There is a decrease in production from 10,000 to 5,000 units. What will happen to per unit variable cost? Per unit variable cost will always remain constant. It is for 1 unit. But total variable cost will decrease. So total variable cost decreases with decrease in production. What will happen to per unit fixed cost? You can easily imagine. Fixed cost per unit will increase because denominator has decreased. Total fixed cost will remain same. That is, numerator will remain the same, total fixed cost, divided by 5,000 units. So per unit burden will go up. So fixed cost per unit increases with decrease in production. However, total fixed cost remains constant. Indirectly, in marginal costing or in CVP analysis, this is also known as CVP analysis, two things are constant. Which two things are constant? Variable cost per unit is constant. Variable cost per unit is constant and fixed cost total is constant. So there are two constants in marginal costing. Variable cost per unit, unless otherwise mentioned. If nothing is mentioned in the question, this by default assumption works. By default assumption of marginal costing works. These are silent assumptions or fundamental assumptions. So for any given question, if there is no further information is available, you can always assume, safely assume that variable cost per unit will remain constant and total fixed cost will remain constant. Is that clear? So these are two constant. Now, why it is called CVP analysis? See, CVP analysis stands for cost volume profit analysis, which says, this analysis says that we are analyzing the behavior of cost and profit due to change in volume of production. It is cost volume profit analysis, means analyzing the behavior of cost and profit due to change in sales volume or due to change in volume of production. Are you getting it? And that is what we have seen. We have just now seen the behavior of cost, how the cost behavior changes due to change in volume. Change in volume is change in production. And if cost changes, naturally profit will change, because sales minus cost only you will get profit. So change in cost will definitely have impact on change in profit. And studying this behavior of cost and profit due to change in volume itself is known as CVP analysis, right? Which is another name used for marginal costing technique. I hope those who wanted to take it down have taken it down, right? And this is nothing new. You have already discussed it in intermediate. So I am going further now. I'll take you to the basic cost formula or equation, that is linear equation of cost. y is equal to ax plus b. It's a linear function, a linear equation where y means total cost. Y stands for total cost. A stands for variable cost per unit which is constant. Please remember, A stands for variable cost per unit which is constant. X stands for number of units which can change. Number of units may increase, decrease. And B is your total fixed cost which is constant. Please remember, fixed cost is total which is constant, and variable cost is per unit. This is also constant. It means in this equation y is equal to ax plus b. There are two constants. A and b are constants, so they won't change. So which values will change? Values of only x and y will change. It is also known as that y is a function of x. I must have written it here. Yes, y is a function of x. Now why y is a function of x? Because the value of y will change due to change in value of x. That is, value of y depends upon value of x. And why it is called linear function? You are the students of mathematics, so I need not tell you this, but still for some people, why it is called linear function? That if you plot the values of x on x axis, it means on x axis if you take number of units, and if you take corresponding values of y, that is corresponding values of total cost on y axis. On x axis you take number of units, and on y axis you take total cost. And if you plot the points, that is coordinates of x and y, different values for x, and you will get corresponding value of y. You take 3-4 values of x and you will get corresponding values of y, so you will get 4 coordinates. If you plot these points and join them by a line, you will get a straight line. If you get a straight line, it is called linear function. And if you get a zigzag or curvy linear line, then it is called non-linear function. Majoritarily we will be dealing with linear function, but at the same time we will also touch upon the non-linear function as we go ahead. So generally in marginal costing we deal with linear function, that is the behavior, a graphical behavior of the total cost line is a straight line. Straight line doesn't mean only vertical or horizontal, it could be diagonal, but it should be straight line. Therefore it is known as linear function. Is that clear, my dear friends? Y is a function of x, that is value of y depends upon the value of x, and a and b, these two are constants, that is variable cost per unit is constant and total fixed cost is constant. Let me tell you one more constant in marginal costing. Unless otherwise mentioned, sales price per unit, sales price per unit also remains constant. What did I say? Another silent assumption in marginal costing is a selling price per unit, I am saying, remains constant irrespective of number of units sold. Now you may not instantly agree with this, because in real life if you want to sell more you have to reduce the sales price, that is a fact. I am saying in absence of information, unless otherwise mentioned, you can assume this because this is again another fundamental assumption. So now there are three constants, my dear friend, in marginal costing as a fundamental assumption. Variable cost per unit is constant, fixed cost total is constant, and sales price per unit. Sales price per unit is also constant because sales function, revenue function is also treated as a linear function. If sales price per unit is constant, then sales line also will be represented by a sales line. So cost function and sales function are assumed to be linear functions for marginal costing purpose. Now we go to the golden formula of marginal costing, which is your sales minus variable cost is equal to contribution. All of you know this marginal costing formula. First we deduct the variable cost from sales to get contribution, and then from contribution we deduct fixed cost to get profit or loss. Now let me tell you where these formulas are printed. I am only discussing these formulas. I will try to discuss some logics behind these formulas. Check, these formulas are printed here. Basic formulas of marginal costing. Getting it? These formulas are printed here on page 176. Then it is printed on, few formulas are here also on page 177. Okay, I am just showing it to you. And then few formulas are printed on page 179 also. So there are in all 16 formulas. There are total 16 formulas. Okay, I will be discussing the possible logic behind these formulas. So formulas are already printed. I will discuss it in my own sequence. Okay. So I'll take you back to the presentation. So we are discussing these formulas, right, which are already printed on page 176, 177 and 178. It's again a revision, as I told you. The golden formula, the most important formula which we generally use in solving the questions of marginal costing is sales minus variable cost is contribution. And from contribution we deduct fixed cost and we get profit or loss. Now from where this word might have come, contribution. For example, if my sales is 10 lakh, my variable cost is 6 lakh, then my contribution is 4 lakh. So this contribution becomes 4 lakh, out of which let us say I deduct fixed cost 3 lakh, so I get profit 1 lakh. Now see it carefully, contribution contributes towards recovery of fixed cost and profitability of the organization. I repeat the sentence, contribution contributes towards recovery of fixed cost and profitability of the organization. Don't you think this contribution 4 lakh has helped you to recover the fixed cost of 3 lakh? So contribution contributes to recover the fixed cost of the organization and it has contributed towards the profitability of the organization. If you reshuffle this formula, you will get contribution is equal to profit plus fixed cost. If I shift the fixed cost to right hand side, I will get contribution is equal to profit plus fixed cost. It means contribution consists of two things. Contribution includes profitability and fixed cost. Therefore, it might have been called as contribution because it is contributing towards recovery of the organization's fixed cost and profitability of the organization. Right. Suppose your contribution is lower than fixed cost. It means your contribution is insufficient to recover the fixed cost. Then you will end up generating a loss. Loss will naturally be negative profit. Can I say profit is excess contribution over fixed cost? Yes, profit is excess contribution over fixed cost, that is contribution left after recovering the fixed cost. Can I say loss is excess fixed cost over contribution? Loss is the unrecovered fixed cost, that is excess fixed cost over contribution can be called as loss. So this is the sentence which I had said, that we can say that excess contribution over fixed cost is profit and excess fixed cost over contribution is a loss. Right. Now you know all this. We are going further now. Right. So these are the golden formulas of marginal costing. Nothing great, you will be easily able to remember them and they are printed in your notes. Now from where this formula was derived? The golden formula of marginal costing was derived from a basic formula, and the basic formula is sales minus total cost is either profit or loss. This is our fundamental formula. From revenue we deduct the total cost to get the profit or loss. From this basic formula, by twisting this basic formula, the formula of marginal costing, that is golden formula, was derived. How? Now in marginal costing, total cost is split in two parts, variable cost and fixed cost. So I will rewrite this formula as like this. What I have done? Total cost I have split in two parts, variable cost plus fixed cost is total cost, correct? So same formula is rewritten. Now I will open the bracket, means this variable plus fixed cost is in the bracket. I will open the bracket. What will happen? It will become sales minus variable cost minus fixed cost equal to profit oblique loss. Now I will put this in the bracket. Any problem mathematically? If I put this in the bracket, it will look like this. Sales minus variable cost I have put in the bracket minus fixed cost is equal to profit oblique loss. Now this entire bracket, sales minus variable cost, is known as contribution. Sales minus variable cost is given a name. This entire bracket is given a name in marginal costing, that is contribution. So this I will substitute by the word contribution. So contribution minus fixed cost will become profit or loss. Now that is how the formulas are designed in CBP analysis. See, nothing but you wanted to deduct total cost from the sales. So it is done step by step. From sales, I will first deduct variable cost. The resultant figure will be called as contribution. Then in the next step, I will deduct fixed cost. And the balancing figure I will call either profit or loss. That is how the formulas are designed. Now I have given a name 1 2 ka 4. 1 2 ka 4 means nothing but the one formula or basic formula by reshuffling mathematically will convert into multiple formulas. So from one formula we will get two or more, right? Therefore I said 1 2 ka 4, right? So we'll try to twist the formulas, basic formulas, to get multiple formulas which can be used to solve the questions. As I am telling you, this is not your CA final syllabus. This is just a quick revision of intermediate, right, of marginal costing. Now this is one of the fundamental formulas. Sales minus variable cost is equal to contribution, right? Well known. Now I am twisting it. Can it be written like this? Means I am shifting contribution to left side and variable cost to right side. That is, sales minus contribution is equal to variable cost. Now naturally it can be done, but it doesn't click at the right time. Sometimes in the question variable cost is missing, but contribution is given. So you deduct the contribution from sales to get the variable cost. Or now I am shifting contribution to right side. So can I get sales is equal to variable cost plus contribution? Now sometimes in the question, if sales itself is missing, but these two are available, variable cost and contribution is available, but we don't use this formula very common, right? What we are habituated of using is this formula, first one. So it should click to your mind that though the sales is not given, but variable cost and contribution is given, so we'll add them together. Variable cost plus contribution will become your sales. Just to make you aware of this, I am revising the formulas. There is otherwise no intention to revise all these simple formulas. That you should be able to use an appropriate formula at appropriate place or at right time. Now I will reshuffle the second formula, this one. Contribution minus fixed cost is equal to profit oblique loss. Now I will consider two situations. One is the situation of profit, means where contribution is more than fixed cost. And next I will consider a situation of loss where fixed cost is more than contribution. So I will consider situation of profit, that assuming there is a profit means your right hand side is positive. It means you have got a profit. Now I will reshuffle the formula. Assuming there is a profit, I will reshuffle the formula. Contribution is equal to fixed cost plus profit. If you take the fixed cost to right hand side, it will become positive. So contribution is equal to fixed cost plus profit. If anybody is interested, we'll take it down, right? Though it is not compulsory because it's already there in your mind. So if contribution is missing, how you can calculate? Fixed cost plus profit can give you the contribution, or contribution minus profit. I am taking profit here. Contribution minus profit will be equal to fixed cost. Sometimes in the question fixed cost is missing, so you can calculate it as contribution minus profit is your fixed cost. Now you don't have to remember these formulas by heart, but you have to remember this logic, that remember the basic formula and reshuffle the formula to get multiple formulas. Now we'll take a situation of loss. Loss means right hand side is negative now. Please remember, right hand side is negative now. And now I am reshuffling the formula with right hand side negative. So reshuffled formula will become contribution is equal to fixed cost minus loss. See, fixed cost has gone to right hand side, so it will become positive, but loss was already there, which was already negative. So contribution is equal to fixed cost minus loss. Now I will shift loss to the left hand side. So it will become contribution plus loss. This minus will become plus. Contribution plus loss will become equal to fixed cost. So see the formula of fixed cost. Fixed cost is either contribution minus profit or contribution plus loss. Could be fixed cost. I hope those who wanted have taken it down. Right. And see, one thing you can always do, those who take more time to write down, they can always pause the video and take it down in their notebook and then again restart the video. So you can pause the screen and take it down as per your choice. I'm going ahead. So we have reshuffled the formulas and created more formulas from the fundamental or golden formula of marginal costing. Some basic assumptions which I have already discussed with you. One is all costs are divisible in two parts, namely either variable cost or fixed cost. Total fixed cost remains constant irrespective of level of activity. Level of activity here means number of units produced, right? Produced and sold. So whether the number of units produced goes up or down, total fixed cost will always remain constant. Variable cost per unit remains constant irrespective of level of activity. Per unit remains constant. We have already discussed them, right? Sales price per unit remains constant. Three things are constant as I told you. Sales price per unit is constant, variable cost per unit is constant, and total fixed cost is constant. These three are constants. So sales price per unit remains constant irrespective of level of activity. Now saying this is mathematically saying that revenue function, sales function is linear and cost function is linear. So cost and revenue functions are linear. Saying this mathematically and saying this what is written on the screen is one and the same, only wordings are different, meaning is same. Now we go to PV ratio, profit volume ratio. All of you are aware of because you have used it so many times in intermediate. PV ratio called as contribution or calculated as contribution upon sales into 100. All of you are aware. Really speaking, it is contribution to sales ratio. Really speaking, it is contribution to sales ratio, but popularly called as profit volume ratio. Profit word is used as a substitute for contribution. Actually, contribution is as good as treated as gross profit in marginal costing, because contribution contributes towards recovery of fixed cost and profit. So contribution is used just as substitute for profit word is used as a substitute for contribution because it is similar to gross profit, and volume means sales volume, and therefore the name has become profit volume ratio, right? Really speaking, it is contribution to sales ratio, that is PV ratio. Now I will divide sales in two parts, that is variable cost and contribution. All of you are aware sales minus variable cost is contribution, or sales minus contribution is variable cost, or variable cost plus contribution is equal to sales. This we had already done 1 to 4. Now variable cost divided by sales into 100. Variable cost numerator, sales denominator into 100. We will get variable cost ratio. Variable cost divided by sales into 100, you will get variable cost ratio, and contribution divided by sales into 100, we will get PV ratio. So contribution divided by sales is PV ratio. For both the ratios, the denominator is sales. Don't forget that, right? For variable cost ratio also denominator is sales. For PV ratio also denominator is sales. Now one interesting observation. Suppose my sales price is 100 per unit, which will remain constant. Suppose my variable cost per unit is 60, which is again constant. This is constant, this is constant, okay? Don't you think this contribution 40 per unit will automatically remain constant? Two assumptions we had already made. Sales price per unit is constant, variable cost per unit is constant. From these two assumptions, third will automatically happen, that is contribution per unit will remain constant, correct? Contribution per unit I am saying, not total contribution, because total contribution depends upon total number of units sold. Contribution per unit into number of units sold. I am going further now. Now variable cost divided by selling price into 100, my variable cost ratio will become 60%, 60 upon 100, 60%, and PV ratio, that is 40 upon 100, will become 40%. Now I am saying your variable cost ratio or PV ratio for a given question will also remain constant. Why? Because selling price per unit is constant, variable cost per unit is constant, contribution per unit is constant. So naturally ratios will also be constant. So indirectly, variable cost ratio and profit volume ratio remains constant. If you want, you may write it somewhere in your notebook. I will utter the sentence again. From all this, what you have to understand is variable cost ratio and PV ratio remains constant. Variable cost ratio and PV ratio remains constant. See, whatever you want to take down, it's your choice, right? Either store it in your mind. If you think that this will get evaporated, you will forget, then put it down in your notebook. Now one more observation. Listen to me carefully. Variable cost ratio and PV ratio are complementary to each other. Variable cost ratio and PV ratio are complementary to each other. Now what do we mean by complementary to each other? Complementary to each other means total of these two ratios, variable cost and PV ratio, will always be 100%. Yes, my dear friends, because these are two parts of sales. Sales is your base. Sales is 100%. If out of 100% sales, if 70% is variable cost, then 30% will be PV ratio. If 25% is PV ratio, then 75% will be variable cost. Are you getting it? That is what is called as that these two ratios are complementary to each other. Variable cost ratio and PV ratio together will always be 100%. And if one ratio is available, second can be calculated orally. So if variable cost ratio is 80%, PV ratio will be 20%. If PV ratio is 10%, variable cost ratio will be 90%. So if you want to write down that observation, what you will be writing? What you will be writing in your notebook? Variable cost ratio and PV ratio are complementary to each other. If you are writing, I am dictating, variable cost ratio and PV ratio are complementary to each other. Are complementary to each other. Full stop. It means the total of these two ratios is always 100%. It means the total of these two ratios is always 100%. Okay friends, I'll go ahead. Those who wanted have either taken it down here or in the notebook. Now again I'll reshuffle the PV ratio and we'll get two more ratios. Our PV ratio formula is what? Contribution divided by sales, correct? I will reshuffle this. I'll take sales to the left hand side and PV ratio below. So it will become contribution upon PV ratio is equal to sales, correct? Just reshuffling of the formulas 1, 2, 4. So in case if in the question sales is missing, you can do it like this, contribution upon PV ratio. It is similar to your gross profit upon GP ratio. We used to get sales, right? In ratio analysis, you have used this formula, that was gross profit upon GP ratio. So it is almost similar. Instead of gross profit here in marginal costing, we use the word contribution, and instead of GP ratio, we use the word PV ratio. Indirectly, I want to say PV ratio is very, very close to GP ratio. PV ratio is very close to, but not same, not exactly same, but PV ratio is very close to gross profit ratio of your accounting. So this is the formula we get. One more formula if we reshuffle. If you multiply PV ratio with sales, sales into PV ratio is contribution. So from original formula PV ratio, original formula is contribution upon sales is PV ratio. If you reshuffle, you will get two more formulas, that is sales is equal to contribution divided by PV ratio and sales into PV ratio is contribution. Now we'll discuss break-even point. Right? All these formulas, as I told you, are printed somewhere in your notes on 3 pages. Only I am discussing it in my own sequence. I may not discuss it in the same sequence, but I will discuss all of them. Break-even point. All of you are aware of this, and we used to solve the questions of BEP in your intermediate, and we will also revise it here few questions just to refresh the memory. Break-even point. Break-even point is always the sales. Please remember, it is always sales at which there is no profit, no loss. So it is the point of sales at which there is no profit, no loss. So it is the point at which there is no profit or no loss. It means you achieve that level of sales at which neither you suffer a loss nor you earn any profit. So when you reach to that level of sales, when you reach to that point, right, that point of sales naturally, then that point is known as break-even point. It means at BEP, total contribution is equal to total fixed cost. I hope you are not surprised. At break-even point, your contribution becomes exactly equal to fixed cost, because contribution minus fixed cost is your profit oblique loss, my dear friend, and it is nil. Profit oblique loss is nil. It means you have earned just sufficient contribution to exactly recover the fixed cost. It means you have reached to break-even point. So at break-even point, you have earned just sufficient contribution to exactly recover the fixed cost. So fixed cost and contribution will become equal only when? Only at break-even point, not otherwise. Not otherwise. Because at BEP there is no profit, no loss. So saying no profit, no loss and saying total contribution is equal to total fixed cost is one and the same. Both the sentence mathematically means one and the same. Now management is interested in knowing break-even point because the first objective of management is to cross BEP. Now once a student had asked me a very funny question that, sir, when at BEP there is no profit and no loss, now then why do we calculate it? What is the use of it when there is no profit, no loss? Why the hell we do it? I said it is only for information. It is only for the information. He said, then for what purpose this information is useful? I said it is for the purpose of decision making. See, at BEP there is no profit, no loss means BEP sales. If your sales goes below BEP, you will suffer losses. And if your sales is above BEP, you will be in profit. Now you must know that cutoff point. You must know that cutoff point from where you start generating profit. And naturally every management's objective will be to stay above BEP. You would always like your sales to be above break-even point so that you are in profit. But you should know that cutoff point. Just to tell you that in your institute's examination, your passing marks required are minimum 40% per subject and aggregate 50%. Now what is this? This is nothing but break-even point. If your score is below break-even point, what will happen? There is a loss of 6 months. So this information is useful to you because your first attempt will be, your first effort will be when you enter the exam hall to cross BEP. That is to cross individual score of 40 and aggregate score of 50%. So that is how that information is useful. So as for you, the cutoff points are 40 marks, 40% marks and 50% marks. Similarly, in the organization, there are break-even points for doing the business in profit. So that is the importance of break-even point. A firm starts earning profit only after crossing BEP, right? When you cross BEP, then only you earn profit. Now, BEP is always calculated for a particular period, please remember. It means if the fixed cost given in the question is for 1 month, then your answer of BEP will be for 1 month. If fixed cost is given for a quarter, your BEP will be for 1 quarter. Right? Because in 1 quarter you have to recover that much fixed cost. Fixed cost is related to period. So BEP also relates to that period for which fixed cost is given. If in the question the fixed cost is given for a year, then your answer BEP calculated is for 1 year. Suppose my break-even point comes rupees 10 lakh sales for 1 year based on yearly fixed cost. It means every year I should sell minimum rupees 10 lakh sales, or every year I should generate a sale of rupees 10 lakh, then only I can earn profit. For next year again I have to generate a minimum sale of 10 lakh. If 10 lakh rupees is my BEP sales, then now BEP can be calculated or expressed in three different ways. Means answer of BEP can be either expressed in number of units. In this case we say that how many units I should sell to achieve break even point, right? Then other way of expressing is in sale value, that is in rupees term. So I can say how much should be my sales revenue in rupees to achieve break even point. So break even point can be written in rupees sale, that is in value or in number of units, or very rarely BEP is also expressed in percentage capacity. That is out of my total manufacturing capacity, how much percentage capacity I have to use to generate break even point. Because when you sell the goods, you have to also produce the goods. Unless you produce, how you will sell? So if you want to achieve a sales, let us say of 10 lakh units, 10 lakh units I said, so you have to first produce also 10 lakh units in order to sell them. So for production manager, it will be important to know at what percentage of capacity if we operate our plant, we can achieve break even. Now we'll understand these three through an example. So I'll give you the example and we'll calculate all these three answers, that is number of units, BEP in number of units, BEP in sale value, and BEP in percentage capacity. So friends, before we start calculating BEP, I'll just take you through three formulas of calculation of BEP. Now these three formulas are for number of units, for sale value, and for percentage capacity. And my dear friends, these are printed. These three formulas are printed in your notes at serial number 7. At serial number 7, if you want me, I'll just show you where it is printed. Yes, it is here. In your printed notes, it is printed here. There are three formulas, one for calculation of number of units, another for sales in rupees, and another in percentage capacity. So I'll discuss these three formulas and then we'll take an example. Okay. So let's go. If you want the answer of BEP in number of units, then the formula is numerator total fixed cost divided by contribution per unit. You have studied this formula, total fixed cost in the numerator and denominator is contribution per unit, right? You have to remember this formula. We will see the logic also behind this formula. If you use this formula, your answer will be in number of units. How many units you should sell to achieve that break even point, that is no profit, no loss. Then BEP for calculation of answer in rupees sales. So the formula is numerator is total fixed cost but divided by PV ratio, profit volume ratio. It means if fixed cost is divided by PV ratio, the answer comes in rupees sales. And if you want the answer of BEP in percentage capacity, then the formula is numerator total fixed cost divided by contribution at 1% capacity. The denominator is contribution at 1% capacity. Okay. Now some of you might not have studied this formula, right? So we will discuss it through an example as I told you. First of all, I'll summarize all three formulas into one. 3 into 1. You would have noticed in all the three formulas the numerator was same. So numerator is total fixed cost. What is changing is only the denominator. Only the denominator is changing. So denominator could be either contribution per unit, or denominator could be PV ratio, or denominator could be contribution at 1% capacity. If fixed cost is divided by per unit contribution, the answer will be in number of units. If fixed cost is divided by PV ratio, the answer will be in rupees sales. If fixed cost is divided by contribution at 1% capacity, the BEP answer will be in percentage capacity. So I put all three of them at one place. Now we'll take an example and I would recommend you to write down this example because we'll be solving this example, right? Unless you feel that okay, we know everything of intermediate, right? We don't need a revision, then the situation is different. But what happens when I receive the queries from the students, I find that even CA final students lack the basic understanding, and that is the reason why I am revising, because I have got such queries Very, very basic queries which even CA intermediate students don't ask. Sometimes CA final students ask, because some few students, very few, not all, but few students have kept this chapter itself for option in intermediate. So they have not touched it at all in intermediate. So naturally it will be difficult for them to capture CA final. And that is why I don't take any chances and I start from the scratch, from base 0. That is the reason I have to revise the formulas or I have to revise the basic questions. Otherwise, I don't want to underestimate your intelligence or your knowledge. You are at CA final, so I don't want to underestimate it. But while teaching, I have to take care of each and every student, the smartest students and the weakest students, right? And based on past queries which keeps coming to me, I have to change my way of teaching. Anyway, it is better that if you take down the example. So start writing, write down the data. Sales price per unit is equal to rupees 10. Sales price per unit, right hand side rupees 10. Variable cost per unit is equal to rupees 6. Variable cost per unit is equal to rupees 6. Now naturally 10 minus 6, you will get contribution per unit. So contribution per unit is equal to rupees 4. Contribution per unit is equal to rupees 4. From here we will get PV ratio. So PV ratio, which is nothing but 4 divided by 10, so that is 40%. So profit volume ratio is equal to 40%. Profit volume ratio is equal to 40%. Now total fixed cost, rupees 40,000. Total fixed cost, rupees 40,000. This is the data for calculation of BP. And total plant capacity, means our plant and machinery has a capacity to produce 25,000 units in a given period. So total plant capacity is 25,000 units. Total plant capacity is 25,000 units. This is the basic data, and now we'll start calculating BEP. Okay, should we go? We'll calculate 3 BEPs. Write down below this data, write down BP in number of units. BP in number of units. First you will write the formula, then answer. So what formula you will write? BP in number of units is equal to, write down, I am dictating and you also know it. Numerator total fixed cost, numerator total fixed cost divided by contribution per unit, divided by contribution per unit. Now let's substitute the data. Total fixed cost is 40,000 divided by contribution per unit is 4. You have this data with you. So 40,000 divided by 4, the answer will be 10,000. But this answer is in number of units. So while writing, you will write 10,000 units. So you have to write this measuring unit. Don't just write 10,000. Only 10,000 means what? Liters, meters, kilometers, rupees, what is it? So it is 10,000 units. So answer becomes complete. Okay. Next write down BP in rupees sales or BP in sale value. BP in sale value. First write down the formula. BP in sale value is equal to total fixed cost divided by PV ratio. Total fixed cost divided by PV ratio. Now substitute the data. Total fixed cost rupees 40,000 divided by PV ratio 40%. Right? Sit with the calculator. Right? Always keep calculator in front of you. So 40,000 divided by 40%. Right? You will get the answer 1 lakh, but it is rupees 1 lakh because it is in value. So answer is rupees 1 lakh. This is BP in rupees. Now third one, which might be new for someone. Write down BP in percentage capacity. BP in percentage capacity. First write down the formula. BP in percentage capacity is equal to total fixed cost divided by divided by contribution at 1% capacity. Total fixed cost divided by contribution at 1% capacity. Written is equal to, substitute the data. Total fixed cost is 40,000. Now the problem is how to calculate contribution at 1% capacity, correct? For some people. Now I think I had given you the total plant capacity as 25,000 units. If 25,000 units is your total capacity, that's a 100% capacity, then if you operate your plant at 1% capacity, how many units you will be able to produce? At 1% capacity is equal to 250 units. And contribution earned by 250 units is contribution earned at 1% capacity. Now your contribution is rupees 4 per unit. So into 4, 250 units is 1% capacity and contribution per unit is 4 rupees. So contribution at 1% capacity will be 1000 rupees. So denominator is 1000, and how this 1000 rupees is calculated? 250 units into 4. 250 units is 1% capacity. Write it down the way you want so that you understand it later on. So rupees 40,000 divided by 1000. Now these 3 zeros will go away. Answer will be 40, but this 40 is 40% capacity. This 40 is 40% capacity. So answer of BP is 40% capacity. It means out of your total capacity of the plant, if you use 40% capacity, then you will be able to just achieve break-even point. It means your plant should operate above 40% capacity to generate profit. Done. So writing work is over. Now I'll discuss a little more. I'll just take you to all in one, just for understanding purpose. Numerator total fixed cost 40,000. Denominator is either contribution per unit 4 rupees or PV ratio 40% or contribution at 1% capacity is 1000. Now let's try to understand what logic works behind this. Okay, and you will get these 3 answers: 10,000 units or rupees 1 lakh or 40% capacity. All 3 means one and the same, my dear friends. Now how all 3 means one and the same? You are selling 10,000 units to achieve BP and your sales price per unit is 10 written in the data. So 10,000 units sold at the rate of 10 will generate a sales revenue of 1 lakh. So in rupees it is 1 lakh or in units it is 10,000 is one and the same. Similarly, 10,000 units you are producing out of your total capacity, plant capacity of 25,000 units to achieve BP. So 10,000 units out of 25,000 units is what percentage capacity? It's 40% capacity. You can calculate and cross check. Producing and selling 10,000 units out of total capacity available of 25,000 units means as good as using 40% capacity. So all 3 answers means one and the same, only they are expressed differently. One is expressed in units, another is in rupees, third one is in percentage capacity. Right? So it can be cross checked, or even one answer calculated, you can calculate other answers without going through the formula also. Now let's see the logic which works behind this BEP formula. I have changed the wordings of the numerator. Denominator I am keeping same. Now numerator was earlier total fixed cost. Numerator was earlier total fixed cost and your total fixed cost is 40,000. But if you remember, at BEP fixed cost is equal to contribution. So same fixed cost 40,000, I am now calling it as desired contribution to recover the fixed cost. Because at BEP we should earn just sufficient contribution to exactly recover our fixed cost. So if your 40,000 is your fixed cost, I desire to earn a contribution of 40,000 to recover the fixed cost and achieve break-even point. So I've just changed the name, not the logic. So for some time I am calling numerator as desired contribution. Now my desired contribution is 40,000 and contribution per unit is 4. It means if I want to earn rupees 4 contribution, I should sell 1 unit. Now, if I want to earn 40,000, if my desired contribution is 40,000, how many units I should sell? If you solve it mathematically using cross multiplication, the formula will become 40,000 divided by 4, and that is the formula of your BEP. That is how the formula is derived. Even otherwise you can calculate it mathematically. For 4 rupees, to earn 4 rupees contribution, if you want to sell 1 unit, then to earn 40,000 rupees desired contribution. The desired contribution is nothing but fixed cost. So to earn 40,000 contribution, how many units you have to sell? Automatically you will get the answer. Now, let us see PV ratio 40%. 40% means 40 upon 100. Can I say to earn rupees 40 contribution, I have to generate a sales of rupees 100. Correct? To earn 40 rupees contribution, I have to generate a sales of rupees 100. I am using PV ratio. Then to generate 40,000 rupees contribution, how much sale I should make? If you try to solve this, if you want to get the answer of this question mark, you will be doing 40,000 into 100 upon 40. Can I write this as 40,000 divided by 40 upon 100 is one and the same? This 40 upon 100 is PV ratio, that is your denominator. So it is 40,000 divided by PV ratio. 40,000 is your fixed cost. So that is how you get the formula. That is fixed cost divided by PV ratio. Fixed cost is nothing but desired contribution. This desired contribution is nothing but your total fixed cost. Are you getting it? Now I will use this one. Contribution at 1% capacity is 1000 rupees. It means to earn 1000 rupees, you have to use 1% of your plant capacity. Then to earn 40,000 rupees, 40,000 is your desired contribution. How much plant capacity you have to use? That is 40,000 divided by 1000. So that is how we get the formulas of break-even point. The numerator, if you want near BP formula in your printed notes, if you want, in the numerator you will write total fixed cost is nothing but desired total contribution. It means you can write it here anywhere. This fixed cost is nothing but desired contribution in your notes. This is desired total contribution. Getting it? We'll discuss remaining one. Now I am taking you to a formula of volume of sales required to earn desired profit. This is your formula number 9 in your printed notes. It means if in the question they tell you desired profit, means management desires to earn some amount of profit, and that amount of profit is given to you. To generate that much profit, how much sales volume we should generate? It means you are supposed to calculate sales volume to earn your targeted profit or desired profit. And the formula which is already printed in your notes is numerator is desired profit plus fixed cost. Desired profit plus fixed cost divided by same, either contribution per unit or PV ratio or contribution at 1% capacity, either or, depending upon how you want the answer. If you want the answer in number of units, divided by contribution per unit. If you want the answer in rupees, divided by PV ratio. Or if you want the answer in percentage capacity, divided by contribution at 1% capacity. Now, what is this desired profit plus fixed cost? My dear friend, our formula was contribution minus fixed cost is profit. Can I say, therefore, contribution is equal to profit plus fixed cost? Same formula is written. This desired profit plus fixed cost is nothing but desired contribution. So this whole bracket is nothing but a desired contribution once again. This whole numerator is nothing but your desired contribution. So once again, desired contribution is known to you divided by contribution expected on 1 unit. So how many units you should sell? Same logic of BP. Even in the BP formula, I said the numerator was written as fixed cost, but that fixed cost was nothing but desired contribution only. So this formula is exactly same as BP. So numerator is nothing but desired contribution. If you want, you can once again write it here. This is your formula number 9. This desired profit plus fixed cost is nothing but desired contribution. in your printed notes. So it is same formula as BP. So how much total contribution you desire, divide by appropriate denominator and you will get the answer. For example, my fixed cost is 40,000 and my desired profit is 20,000. So to earn 20,000 profit after recovering a fixed cost of 40,000, it means I should generate a contribution of 60,000 rupees divided by 4 rupees per unit. Getting it? So you'll have to sell 15,000 units in that case. If you desire to earn a profit of 20,000 rupees, you'll have to generate a sales of 15,000 units. Similarly, if you divide it by PV ratio, you'll get the answer in rupees sales and so on. Okay, we go ahead. Profitability at a desired level of output. Now see, there is a change. Here you will calculate profit. For a desired level of output, it means level of activity is given to you, level of output is given to you, or level of sales is given to you. And at that sales, how much profit you expect, that is been asked. So your desired, your profit is to be calculated for a desired level of sales or desired level of activity. Now, for profit, actually we need to calculate profit. The basic formula of calculation of profit is total contribution minus total fixed cost. That is, contribution minus fixed cost is profit. But contribution will calculate depending upon the way this level of output is given. If level of activity or level of output is given in units, then what we will do? If the data is given to you in number of units, then number of units into contribution per unit, you will get total contribution. In total contribution minus fixed cost, you will get profit. Formulas are already printed in your notes. Suppose if the level of activity is given to you in sales rupees, then sales in rupees into PV ratio. We have already seen this. Sales into PV ratio, you get contribution. To sales into PV ratio, you will get this total contribution minus fixed cost. You will get profit or loss. That is a profit at a given level of activity. If the given level of activity is in rupees sales. And if the level of activity is given in percentage capacity, then percentage capacity multiplied by contribution at 1% capacity. You will get total contribution again. At 1%, how much you earn into the percentage at which you would like to operate. Once again, you will get total contribution minus fixed cost and you will get profit or loss. Nothing great. Okay, I'll take you to margin of safety now. Please remember, margin of safety is again sales. Like BP is sales. BP is always sales. Similarly, margin of safety is also sales. Margin of safety is the sales in excess of BP sales. Please remember, margin of safety is not profit. Margin of safety is sales. But it is excess sale over BP. Like just for example's sake, in the exam, your CA exam, let us say 0, 50 marks is your BP. Maximum marks are 100. But your marks are, let us say, 70. This is your score. So your score is 70, BP score is 50. So what is the extra score? This extra above BP is 20 marks. This 20 marks which you have scored above BP is your margin of safety. So this 20 is your margin of safety. Similarly, in the business organization, we say whatever sales we have generated in excess of BP sales, that extra sales is your margin of safety sales. Margin of safety is always margin of safety sales, like BP sales, margin of safety sales. So we can say margin of safety sales is equal to your total sales. Total means your actual total sales, whatever you have generated. Actual sales minus BP sales. Right? You may call it as total sales or actual sales. Your actual sales minus BP sales is margin of safety sales. Now, margin of safety ratio. It means margin of safety can be expressed in percentage. To express the margin of safety in ratio, you have to take this margin of safety sales here divided by this total sales or actual sales into 100. Right? Margin of safety ratio can be calculated as your margin of safety sales divided by total sales into 100. In our recent example, we had seen that you have scored 20 marks extra out of 70, please remember, out of 70, your actual mark score was 70. So 20 upon 70 into 100 will be your margin of safety ratio in your CA exam, assuming your actual score is 70 marks. If suppose your actual score is 80 marks, 80, then margin of safety will be 30, no? 80 minus BEP 50. So margin of safety will become 30 divided by your actual score is 80, because out of 80, 30 is extra. Out of 80, your excess marks are 30. So 30 divided by 80 into 100. This is how you will get your margin of safety ratio. Okay. As the name suggests, it is the safety margin available to you, because you are above BEP. It means that much is the safe margin available to you. So margin of safety indicates the safety margin, right? Now, margin of safety ratio, I'll show it to you in a different way. Our total sales, whatever total sales we have generated, total sales minus BEP sales is your margin of safety sales. Whatever total actual sales we have generated, we divide it in two parts. It means total sales minus BEP sales is margin of safety sales, and total sales minus margin of safety sales can be BEP sales. Okay. Now I will calculate BEP ratio. BEP ratio, that is BEP sales upon total sales into 100. BEP sales divided by total sales into 100 will get BEP ratio also, just like margin of safety ratio. And margin of safety sales divided by total sales, margin of safety sales divided by total sales into 100 will get MOS ratio. So BEP ratio and MOS ratio. Don't you think if this total sales is my denominator, that is base 100%, and my BEP ratio is 40%, then margin of safety ratio will be 60%. Or if margin of safety ratio is 70%, then BEP ratio is 30%. Once again, it means BEP ratio and margin of safety ratio are complementary to each other. If you want, you may write down whatever you want. Actually, I want you to note an observation that BEP ratio and MOS ratio are complementary to each other. This is what you have to note somewhere. BEP ratio and margin of safety ratio are complementary to each other. If you want, you can write down in your notebook. It means the total of BEP ratio and MOS ratio will always be 100%. Total of BEP ratio and MOS ratio will always be 100%. And please remember, the base is your total sales, total actual sales. If in the question they tell you that we are expecting a safety margin of, let us say safety margin of 30%, it means immediately it should click to your mind BEP ratio is 70%. If they tell you our BEP ratio is 40%, then it should click to you that margin of safety ratio is 60%. This will be useful for basic questions basically. Okay, those who wanted have taken it down. Now another interesting thing we will see. Now, how to extract profit out of margin of safety sales. Please remember, margin of safety sales is never equal to profit because it is sales. On margin of safety sales, whatever contribution you earn, that becomes your profit. So we'll see that formula now. Right, this is the formula which is written at number 16 in your notes. If I show you the notes, right, it is 16 number, this formula. I'm just explaining the logic. Formulas are already printed. Okay, net profit is equal to margin of safety sales into PV ratio. I was telling you net profit is not equal to margin of safety sales. PV ratio into margin of safety sales if you multiply sales with PV ratio, you will get contribution. So I can say contribution earned by margin of safety sales results into net profit. Am I clear? Contribution generated by margin of safety sales is equal to your net profit. Right? Therefore, the formula is net profit is equal to MOS sales into PV ratio. And this formula can be reshuffled, like a net profit upon margin of safety sales, you can get PV ratio. Correct? 1 to 4. Or net profit upon PV ratio, you can get margin of safety sales, and so on. This you can alter and use. Now I will give you the logic behind this formula, why this formula works. Just understand, then I will give you the time to write. If I multiply total sales into PV ratio, I will get total contribution. Correct? I will give you the time to write, don't worry. Total sales into PV ratio, you will get total contribution. Now this total sales I will split in two parts. One is BP sales, another is MOS sales. So I have divided total sales into BP sales and MOS sales, and I am multiplying both of them by PV ratio. Means BP sales into PV ratio and MOS sales into PV ratio. The moment sales into PV ratio is done, I will get contribution. So multiplying this by BP sales by PV ratio, I will get contribution at BP. Correct? And if I multiply MOS ratio into MOS sales into PV ratio, I will get contribution at margin of safety sales. Correct? So I will get contribution at BP sales. But I hope you remember, contribution earned at BP sales is exactly equal to fixed cost. Because at BP, contribution is exactly equal to fixed cost. And contribution earned by margin of safety sales will result into net profit. Now try to understand how. Whatever contribution I have generated from BP sales is utilized to recover the fixed cost. Whatever contribution I have generated from BP sales has gone to or has been utilized to recover my fixed cost. Now fixed cost is fully recovered by the contribution which is generated from BP sales. Now whatever contribution I generated from margin of safety sales, that entire contribution will be profit, because now fixed cost is fully recovered. Fixed cost is fully recovered. So remaining contribution which I earn from margin of safety sales results into my net profit. Are you getting it? Other way of looking at it is, total sales into PV ratio is total contribution, and total contribution minus fixed cost. From total contribution deduct fixed cost, you will get profit. And this is the formula, margin of safety sales into PV ratio. This is the formula written, is equal to your net profit. If you wish, you can write down whatever you want. If you wish, you can write it down in your notebook. The logic behind this formula, how this formula works. Because I have seen at intermediate level, many students have the misconception that margin of safety sales is equal to net profit. No. I am saying contribution generated by margin of safety sales is net profit. And please remember, in marginal costing, we always calculate net profit before interest and tax. This net profit is always EBIT. If I connect it with accounts or FM, accounting or FM. In marginal costing, whatever profit we calculate is always earning before interest and tax. Because in costing, we generally ignore the interest and we generally ignore the taxes. So this net profit is net operating profit. In FM, financial management, this concept was called as operating profit. Operating profit of the business. Operating profit is profit before interest and tax. That is earning before interest and tax. If I can connect it with your leverages, leverage, operating leverage, financial leverage, in case if you remember, or should I not? In operating and financial leverage, if you remember, it was a sales minus variable cost, contribution minus fixed cost, operating fixed cost was your EBIT. If you remember, right? And EBIT minus interest was your EBT. And your formula of operating leverage was contribution upon EBIT was operating leverage, and this EBIT upon EBT was your financial leverage. Leverage topic of financial management. Anyway, let's not go there. It may happen that I may confuse you by telling you more, but this all you had studied. Okay, operating profit is this net profit. I hope you have taken down whatever you wanted. This formula is derived here. This is how it is. MOS sales into PV ratio. So one last time I am repeating. Net profit is nothing but contribution earned by margin of safety cells. Because contribution generated by BP cells is utilized to recover the fixed cost. Therefore, remaining contribution generated by margin of safety cells results into net profit. Okay friends, now understand this. There is an example which I am taking to discuss shortcut formulas. Just wait, understand what I am saying. Formulae number 12, 13, 14 and 15 printed in your notes. I call these formulas as shortcut formulas or differential formulas. I will just show you there. These four formulas. This formula number 12, 13, 14 and 15. These four formulas, I call them as shortcut formulas or differential formulas. Okay. Now, to discuss the logic which works behind these four formulas, I am taking an example which you have to write down also. Right? You will also write down that example, and then we'll use all the four formulas and we'll see the logic which works behind it. So this is an example. I'll just explain the example first. I have taken sales quantity. Just understand, then write. Sales quantity I am taking 10,000 units, 15,000 units, and the difference between these two is written here. That is, difference is 5,000 units. So third line, last line is the differential line, difference between the two levels of activities. Okay. Now selling price I am taking 10 rupees per unit. 10 rupees per unit into 10,000 units is 1 lakh. 10 per unit into 15,000 units is 1,50,000. And difference between the two sales is 50,000 rupees. This is sales in rupees. Differential sales is rupees 50,000. Just understand, I will give you the time to write. Don't worry. Now I am taking variable cost at the rate of 6 per unit. 6 per unit into 10,000 is 60,000 rupees. 6 per unit into 15,000 is 90,000. And the difference between these two is 30,000. This is difference in variable cost. Difference in total variable cost. Now 10 rupees sales price, 6 rupees variable cost, 4 rupees is contribution per unit. Contribution per unit into number of units, I will get total contribution. Contribution per unit into number of units, I will get total contribution, 40,000 and 60,000. The difference between 40 and 60,000 is 20,000. So 20,000 is differential contribution. Is that okay? Fixed cost I am assuming 25,000. And 25,000 will remain same irrespective of level of activity. So the difference in fixed cost is 0. As fixed cost remains the same or constant, the differential fixed cost is generally 0. Now, this contribution minus fixed cost, contribution minus fixed cost is profit, right? Profit is 15,000, and this 60,000 minus 25,000, profit is 35,000. Is that okay? Now, difference in profit, difference in these two profits is 20,000. That is differential profit. And now we'll take total cost. Total cost is variable cost plus fixed cost. That is these two totals. Variable cost 60,000 plus fixed cost 25,000. Total cost 85,000. Variable cost 90,000. Fixed cost 25,000. Total cost 1,15,000. And difference in total cost is 30,000. I have just explained you the data. right? What data it is and what this differential line is. Third line is the difference between these two. Okay. Now you take down this data so that we'll check the validity of formula number 12, 13, 14 and 15. Please write it down quickly. Because with this discussion, after we discuss these 4 formulas, our revision of formulas will be over. Revision of basics of marginal costing and the formulas will be over. Then we'll be moving to the questions. We'll start solving the questions then. I hope data is taken down. And you will always keep the priority like this. First priority is always understanding the concept. First priority. Second priority is writing. And third priority is decoration. Decoration means some people have the habit of decorating the answer with multicolor pens and sketch pen, marker pens, right? Putting line like this. That is called decoration. Decoration is never our objective. But if the time given by me is sufficient, you can do all 3. If you think the time given by me is insufficient, then first priority always will be on understanding the concept. Second priority will be writing, right? Because for writing you can even, as I told you, you can pause the lecture and write it down from the screen. And third priority will be decoration. Decoration should be last priority. CA students already have shortage of time. Okay, should we start the testing of the validity of 1 by 1 formulae? For testing purpose, you will write the formula, you will write the data in the formula, and we will get the answer. And then we will see why this answer appears, what logic works behind it. Okay friends, in this much time, I hope this data is taken down. So I am taking you further now. Okay, below this table or below this data, you will write the formula, this formula. Table will always remain on the screen. Write on the formula, variable cost per unit is equal to. Write the formula, variable cost per unit is equal to change in total cost divided by change in output. Variable cost per unit is equal to change in total cost divided by change in output. Written? Now substitute the data which I am dictating. This change means difference in total cost is 30,000. So in the numerator you will write rupees 30,000. Change in total cost 30,000. And change in output, output means quantity. That is difference in quantity. So divided by you will write 5,000 units. Rupees 30,000 divided by 5,000 units. Your answer will be rupees 6 per unit, correct? Your answer will be rupees 6 per unit. Written 30,000 divided by 5,000 units is equal to 6 per unit. Now let us see whether this formula works and then why it works. First of all, this 6 per unit is check. This is your variable cost per unit. So you got variable cost per unit. Now how you got or why you got variable cost per unit, and that is very interesting. Now try to understand. Your total cost consists of 2 parts, variable cost plus fixed cost, right? That is this plus this plus this. Now you will notice there is no change in fixed cost. The difference in fixed cost is 0 because fixed cost doesn't change. Then what is changing is only variable cost is changing. You will notice this change in variable cost and change in total cost is same. Try to understand this logic. Total cost consists of two parts, variable and fixed, out of which this doesn't change. Fixed cost doesn't change. What changes is only the variable cost. It means change in total cost and change in variable cost is one and the same because of the assumption fixed cost remains constant. So for some time I will write it as this change in total cost, I will write it as change in variable cost. For some time I will write change in total cost as change in variable cost, because you have seen through the example that change in total cost and change in variable cost is same, divided by change in output. So the new formula becomes, logical formula becomes numerator change in variable cost upon change in output. I will delete this common word, change word I will delete. So the formula will become variable cost upon output. My dear friends, if variable cost is divided by output in number of units, variable cost divided by output, you must get variable cost per unit of output only, isn't it? Variable cost divided by output, naturally you will get variable cost per unit of output. So for writing purpose, numerator is change in total cost. For logical purpose, the numerator is, it is change in variable cost. It means here you can write the formula. What is printed is change in total cost. You will write here as change in variable cost. For your purpose, it is change in variable cost upon change in output. This is the logic. Change in total cost is indirectly change in variable cost. Getting it? Understood the logic? And just to prove this, I have taken the data, because only theoretically if I discuss, you may not agree with me. So you can see the entire change in variable cost has resulted into change in total cost also. Okay, we take another one, another formula. Whatever you wanted to write, you have written. Basically store it here. Another formula write down in your notebook. Contribution per unit is equal to, contribution per unit is equal to change in profit upon change in output. Contribution per unit is equal to change in profit upon change in output. Now substitute the data. See, change means difference in profit. This difference in profit is rupees 20,000. So change in profit you will write rupees 20,000. And change in output you will write 5,000 units. So divided by 5,000 units. Now rupees 20,000 divided by 5,000 units, you will get rupees 4 per unit. So write down below rupees 4 per unit as an answer. Now we have to check whether 4 per unit is a contribution per unit or not. So my dear friends, this 4 per unit is a contribution per unit. So it tallies. Correct? Now let's understand how this formula works. How change in profit upon change in output you get contribution per unit. My dear friends, this change in contribution and change in profit is one and the same. I repeat, change in contribution and change in profit is same. It is in front of you. So this change in profit for the time being is change in contribution. Now why? See, profit is contribution minus fixed cost, out of which this fixed cost is constant. There is no change in fixed cost. So what is changing is only the contribution. Just see here. Profit is a result of contribution minus fixed cost, out of which fixed cost is constant. So this is contribution, this is fixed cost, this minus this is profit. This changes, contribution changes, fixed cost doesn't change. And then you get profit. If this doesn't change, this change in profit is due to change in contribution. So this change in profit and change in contribution is one and the same. So I have rewritten the formula as change in profit can be written as change in contribution upon change in output. Now you delete this word change, you will get the formula as contribution upon output. If contribution is divided by output, naturally we will get contribution per unit of output, and that is what we got, contribution per unit of output. So what you can do, either you can write in your notebook or in your printed notes. In this printed notes, this change in profit is nothing but change in contribution. So this formula is change in contribution upon change in output. You can write it here in the printed notes or in your notebook. Right, the logic why this formula is working. So numerator is change in contribution. Is that clear, my dear friends? And change in contribution results into change in profit. So change in profit and change in contribution is one and the same because fixed cost is constant. Now we'll go to the third formula. PV ratio. Write down. PV ratio is equal to change in profit upon change in sales into 100. PV ratio is change in profit upon change in sales into 100. Now substitute the data. Write down change in profit rupees 20,000 and change in sales I am taking. Sales means rupees sales, not output, rupees. So change in sales rupees 50,000, change in profit 20,000, change in sales rupees 50,000, 20,000 upon 50,000 into 100, you will get 40%, correct? You are writing the data and answer also. And I think 40% is your PV ratio. 4 contribution out of 10 rupees is 40%. So you will get the correct PV ratio. Now same logic again. How we got this 40% PV ratio? This change in profit 20,000 is attributable towards change in contribution. So this change in profit is nothing but change in contribution. In mathematical language we say delta contribution, change in contribution. Upon change in sales is same. Now delete this word change. So it becomes contribution upon sales. Contribution numerator, sales denominator. Contribution upon sales into 100. Naturally it will become PV ratio. That is the formula of PV ratio. So numerator for writing purpose is change in profit. For understanding purpose it is change in contribution. It means here you can rewrite this formula as change in profit as change in contribution upon change in sales. When sales I mean rupees, and when I say output it is in units, and sales means in rupees, right? So you will see the formula, delete the word change and you will find contribution upon sales into 100 is the PV ratio formula. Okay. Now we go to the last one. Write down this variable cost ratio we are calculating now. Write down variable cost ratio is equal to change in cost, that is change in total cost naturally. Change in cost upon change in sales, or you can write change in total cost upon change in sales into 100. Change in total cost upon change in sales into 100. Now substitute the data. Change in total cost is rupees 30,000 divided by change in sales is rupees 50,000. So 30,000 upon 50,000 into 100. 30,000 upon 50,000 into 100. So you will get the answer as 60%. And naturally 60% is your variable cost ratio. So your contribution to sales ratio was 40% and your variable cost to sales ratio is 60%. PV ratio and variable cost ratio are complementary to each other. We got 40% PV ratio, so naturally we should get 60% as variable cost ratio. Now again, how this formula is working? Same logic means, my dear friends, this change in cost is attributable to change in variable cost. This and this is same. So this change in cost is nothing but change in variable cost and divided by change in sales. Remove this word change. So it will become variable cost upon sales into 100. So it is variable cost upon sales into 100 is the formula of variable cost ratio. Itself is the formula of variable cost ratio. So if you want, in your notes you can write this logic, variable cost ratio. This logic is nothing but change in variable cost because change in total cost is due to change in variable cost. Change in variable cost upon change in sales into 100. Right? Total cost changes due to change in variable cost. That is the logic. And profit changes due to change in contribution. Contribution changes, by that much profit changes. Variable cost changes, by that much total cost changes, because fixed cost is constant in both the cases. My dear friends, this will hold good only till the time fixed cost is constant, and that is fundamental assumption of marginal costing. Sometimes in the question they may change fixed cost also, that is different. But till the time fixed cost is constant, this logic will work. Okay, dear friends. So this was the discussion, basic discussion of your intermediate marginal costing chapter. I've discussed the formulas, I've discussed some assumptions and so on. And now we have to apply it. Right? We have to start using this to solve the questions. So we have to now solve the questions. First we'll start with basic or simple questions, and then slowly we'll move the level of difficulty, and slowly we'll enter into the CA final zone. Okay friends, so you'll go to question number 1. Yes friends, we are on question number 1, page number 178. Now I think I have told you earlier, my habit is to write like this, question number and page number for easy reference. Now my suggestion is, in your notebook, if you have given the page numbers to your notebook, I had told you in the first lecture that please give page numbers to your notebook. Now suppose you are writing the answer in your notebook and your notebook page number is, let us say, 4. Your notebook page number is 4. While writing the answer in your notebook, you will start with like question 1 by 178, and then you will write the answer here. It means in your notebook you will have the reference of question number as well as page number of printed notes. You will have the reference of question number and page number of printed notes. And one more thing you can do. Near the question, you will write the page number of your notebook. Now I am assuming that the page number of your notebook is 4. So where it is to be written, I will tell you. Near this question, you should write here page 4. It means near the question, you will have the reference of notebook page, and in notebook, you will have the reference of question and page number of printed notes. It is like you are posting of journal entry in the ledger, which you used to write ledger folios. So if you can give the cross references before the exam, you can quickly move either from question to answer, or you can move from answer to question. So this will be very convenient before the exam to refer, if you want to refer a particular answer of a particular question, right? So cross reference habit you can develop, and for that you have to give page numbers to notebook also. In printed notes, we have already given the page number, only you have to give the page numbers to your notebook. And then one more care you have to take. Suppose this is your notebook number 1. Now when you start notebook number 2, please give consecutive numbers. For example, your notebook 1 ends with, let us say it is from page 1 to page 180. So next notebook you will start page numbering 181 onwards. And suppose if it ends at 360, and if you have to start with notebook number 3, you will start it with 361 and so on. So give consecutive page numbers to the notebook, so that same page number won't appear in more than one notebook. Otherwise, page number 4 of which notebook? Page number 4 of notebook 1 or notebook 2 or notebook 3. So please give consecutive page numbering to your notebook as and when you start the new notebook. Is this okay? So I'll read question number 1 now from here only, from your printed notes, and you will write the answer in your notebook. These are very basic questions, please remember. Please remember, these are basic questions of CVP analysis. These are intermediate level questions. These are CA inter level questions and not CA final level questions. It is just for quick revision. It is just for quick revision. These questions are not expected in CA final. If you are very comfortable with these questions, very comfortable, it means if you don't think that these questions are required in any case and you are very strong at the basics of marginal costing, then only you can skip. Because who should skip and who should not is a difficult part, right? I am taking you through these basic questions just to revise all the formulas, application of all the formulas. Let's begin. Question 1 says, the following information is given to you. Fixed overheads rupees 1,80,000, variable cost per unit is 14, selling price per unit is 20. Calculate break-even point. Now, in the question they have not said whether break-even point is required in units or in rupees or in percentage capacity. If that is the situation, then you can calculate BP, generally two popular BPs, either in units or in rupees, whichever you like. That is your choice. Then turnover required, turnover means sales required to earn a profit of 36,000. To generate a desired profit of 36,000, what is the turnover required? And third question is, at a profit of 36,000, express the margin of safety available. Means if you are generating a profit of 36,000, what is the safety margin available to you? It's a very simple question. You can just try on calculator, or you can always keep rough pages, rough pad with you so that you can do the rough work immediately and see your understanding. It is just for checking the understanding of your CA intermediate. There are few questions around, I think there are 11 questions just to check the basic understanding of your intermediate knowledge. Okay, try it on the calculator. We will write it down in your notebook also, right? So let's write down the fair answer in your notebook. Start. Question 1 by 178. Question 1 by 178. Start writing. Number 1, calculation of BEP. Calculation of BEP. I am calculating PV ratio. So write down profit volume ratio. Calculation of BEP. Below that write down profit volume ratio is equal to contribution per unit upon sales price per unit. Right? Either you can take per unit or you can take total contribution upon total sales. It's one and the same. Only numerator denominator should match. If numerator is per unit, denominator should be per unit. If numerator is total contribution, then denominator should be total sales. Your ratio will remain always same. So contribution per unit upon sales price per unit into 100 is equal to, your contribution per unit was 6 rupees. How 6 rupees? 20 minus 14. 20 minus 14, 6 rupees divided by selling price 20 rupees into 100. So it will become 30%. BEP sales is equal to, I am calculating it in rupees. As I said, you can calculate in units also, absolutely no problem, because question is silent. So either in units or in rupees. BEP sales is equal to fixed cost divided by PV ratio. BEP sales is equal to fixed cost divided by PV ratio. Fixed cost is given to you in the question. You will always keep your printed notes in front of you, my dear friends. Always keep your printed notes in front of you because data is to be taken from the question. Your fixed cost is 1,80,000. So rupees 1,80,000 divided by 30%. 1,80,000 divided by 30%. So you'll get the answer rupees 6 lakh. You'll get the answer rupees 6 lakh. Right? Those who have calculated in units, absolutely fine. No problem. Only they will do fixed cost divided by contribution per unit. For units, the BEP formula will be fixed cost upon contribution per unit. This is rupees 6 lakh. Now check the second question. I am assuming your printed notes are constantly in front of you. Second question or second part of the question is, question number 1 only, B part, second part. Is turnover required to earn a profit of 36,000? What should be the turnover for desired profit of 36,000? If you remember the formula which we discussed today only, it is desired profit plus fixed cost divided by PV ratio. Desired profit plus fixed cost divided by PV ratio. So write down number 2. Sales required to earn a profit of rupees 36,000. Sales required to earn a profit of rupees 36,000. Write down the formula. Desired profit plus fixed cost divided by PV ratio is equal to desired profit plus fixed cost divided by PV ratio. So numerator, desired profit 36,000 divided by fixed cost 1,80,000. 36,000 plus 1,80,000 divided by PV ratio 30%. Now question said turnover means sales required, so I am doing it in rupees. Desired profit 36,000 plus fixed cost 1,80,000 divided by 30%. You have to use the calculator, my dear friends. Though the answers are available on the screen, I want you to perform your own calculations. You should have the habit of using calculator and you should be able to do the calculations on your own. This has got one more advantage. In case if I have made the error, you can point it out. Right? In case if I have made the error, you can point it out to me. Answer will be rupees 7,20,000. Rupees 7,20,000. Right. My expectation is you are performing the calculations instead of copying the answers. Because in the exam also you have to develop the answer. Check third part of the question. Third part of the question says, at a profit of 36,000, express the margin of safety. Now we have already done one calculation. At a profit of 36,000, we have got sales. So at this profit, this is the sales. Now this sales minus BEP sales, you will get margin of safety sales. So that is the way we can get it easily, because third question is connected to second part of the question. Therefore it is easy. So number 3, margin of safety. Number 3, margin of safety is equal to MOS sales is equal to total sales minus BEP sales. MOS sales is equal to total sales minus BEP sales is equal to total sales we already knew, that is 7,20,000 minus 6 lakh. 7,20,000 minus 6 lakh. So it is 1,20,000 rupees. 1,20,000 is your margin of safety sales. Now alternatively, there is one more way to calculate the same answer. Now just remember, we had just now discussed the formulas. In your printed notes there is a 16 number formula, which is net profit is equal to MOS sales into PV ratio, correct? Now if I take net profit divided by PV ratio, can I get MOS sales? So directly MOS sales will be net profit, which is given to you in the question as 36,000, divided by PV ratio. So you can use this formula. Net profit is equal to MOS sales into PV ratio. Net profit is equal to MOS sales into PV ratio. From here we will get this formula. Therefore net profit divided by PV ratio. Therefore net profit divided by PV ratio is equal to MOS sales. Net profit divided by PV ratio is equal to MOS sales. Therefore MOS sales is equal to 36,000 divided by 30%. 36,000 divided by 30%. Right. For data you have to always refer the question. So this way also you will get 1,20,000. In the exam you can do it only one of the ways, either this or this. Both the ways you will get the same answer. And in many different ways also you will get the same answer. That is the fun in marginal costing, that you can approach towards the answer using different routes. Your destination will be same, route or path which you are following could be different. Absolutely no problem. Now we will go to question 2. Question 2 by 178. So I will read out the question. Check this. Question number 2. Raj Limited has prepared the following budget estimate for the year ending 31st March. Sales in units, fixed expenses, that is fixed cost or fixed overheads, whatever you call. Sale value is given. variable cost per unit is given. Now you are required to, and there are questions. First question is find PV ratio, break even point and margin of safety. Right? PV ratio, break even point and margin of safety. Now as PV ratio is asked with BP, what I will do? I will calculate BP based on PV ratio. It means I will calculate BP in rupees and margin of safety also in rupees. See, you can always calculate in units, there is no problem, but I will calculate it in rupees. This is the first part, which is very simple. Now see the second part, calculate revised PV ratio, break even point and margin of safety. All three revised, means revised PV ratio, revised break even point and revised margin of safety in each of the following cases. In each of the following cases. And there are 4 cases given below. Each is treated independently. Please remember, each case you will treat separately. It means like case number 1, decrease of 10% in sales price. It means only we will make one change. We will decrease the sales price by 10%. And after decrease of sales price by 10%, we will see the impact on 3 things. How PV ratio changes, BP changes, margin of safety changes. Are you getting it? I am first making the question understandable to you. When we go to B part of the question, that is increase of 10% in variable cost, all the data will go to base level, means original level, and you will make only one change. That is only 10% increase in variable cost. Only one change at a time. It should not be a cumulative change, please remember. You have to calculate the revised answer in each of the cases separately. It means when you are solving B part, don't change A part also. It means don't decrease sales price and also increase variable cost. Only make one change at a time. When we go to C part, only change the sales volume, that is sales quantity by 2000. It will increase by 2000 and we will see the impact on again 3 things, PV ratio, BP and MOS. And last is increase of 6000 in fixed cost. So we will change only fixed cost, all other data will remain same. We will change only fixed cost, we will increase the fixed cost and we will see what impact it has on PV ratio, BP and margin of safety. Just think over. I give you some time to do some thinking, perform some rough calculations on rough pages. Right? For rough pages, you can use even backside, last few pages of your notebook, or keep separate rough pages or rough pad. See, these are intermediate level questions, so you can do it, solve them very easily. Okay, first we will solve the first part, that is original answers, original PV ratio, original BP, original MOS. Once we get this, then we will revise the 3 answers under 4 situations. Each of the situations will calculate 3 answers. So 4 situations into 3 will get 12 more answers after getting original 3 answers. Okay friends, now first of all check this. Your sale value is 1,50,000 rupees and you have sold 15,000 units. So 1,50,000 rupees divided by 15,000 units, you will get sales price. Sales price as rupees 10. Sales price rupees 10 per unit and variable cost 6 per unit. You will get contribution 4 rupees per unit, correct? And we'll start getting the answer. Contribution 4 rupees per unit. So 4 upon 10, 40% will be PV ratio. Right? Break even point will be your fixed cost 34,000 divided by 40%. You will get BP. And then from your total sale value 1,50,000 will deduct BP. So you will get margin of safety and so on. So that is simple. Okay. I'll rub this off. Now we will write down the fair answer. Then we will make one by one changes. Okay. So let's go to the fair answer now. Start writing in your notebook, question 2 by 178. Please write down the answers for future reference. Question 2 by 178, Raj Limited. I'll go slowly. I'll allow you the sufficient time to write down in your notebook. Please utilize that time and keep your notebook updated. Right? Write down sales price per unit is equal to sales price per unit is equal to rupees 1,50,000 divided by 15,000 units. Rupees 1,50,000 divided by 15,000 units is equal to rupees 10 per unit. Is equal to rupees 10 per unit. Contribution per unit is equal to contribution per unit is equal to 10 minus 6, so rupees 4. Contribution per unit is equal to 10 minus 6 is equal to rupees 4. PV ratio is equal to PV ratio is equal to 4 upon 10 into 100. 4 upon 10 into 100 is equal to 40%. 4 upon 10 into 100 is equal to 40%. BP in value. BP in value is equal to fixed cost upon PV ratio. BP in value is equal to fixed cost upon PV ratio is equal to rupees 34,000 divided by 40%. Rupees 34,000 divided by 40%. That is rupees 85,000. That is rupees 85,000. And MOS in value, margin of safety in value. As I said, I am calculating it in value rupees, right? You can calculate in units also, no problem. MOS value is equal to total sales minus BEP sales. Total sales is given to you in the question, that is rupees 1,50,000. So 1,50,000 minus 85,000. Total sales minus BEP sales is 1,50,000 minus 85,000 is equal to rupees 65,000. Is equal to rupees 65,000. So we have got first part of the answers, correct? Now we have to calculate revised answers, right? That is revised PV ratio, revised BP and revised MOS under each situation. Now for this I am preparing a table. In a tabular format I will take 4 situations and 3 answers. So I will prepare a 4 by 3, that is a table of 12 values. Right. So you can also prepare a table around half page of your notebook, full-scape notebook, half page. Calculation of, write down, calculation of revised PV ratio, BEP and MOS. Calculation of revised PV ratio, BEP and MOS. Total 4 columns. First column is particulars and 3 more columns, PV ratio, BEP rupees, MOS rupees, and vertical half page. Always give a suitable heading to the table and then write it. Calculation of revised PV ratio, BEP and MOS. Columns are particulars and 3 columns, PV ratio, BEP and MOS. Ready around half page approximately. Okay, and please note that on my screen I have written statement continued because I could not accommodate the whole answer on one screen. So I will be taking it ahead also. Otherwise you will design the space depending upon my screen size and you will lock the space also. Don't do that. Okay, I am taking you back to the question. Situation 1. Check. Situation 1 is a decrease of 10% in selling price. If you remember, the sales price was calculated by us as rupees 10. If you decrease it by 10%, it will become rupees 9, correct? Now only sales price per unit will decrease because it is mentioned in the question. Now variable cost per unit, will that also decrease by 10%? No. Have they mentioned anything about variable cost? If nothing is mentioned, variable cost per unit remains the same, fixed cost total remains same. So this will remain the same, 6 rupees. So your variable cost will remain same 6 rupees, but contribution will become rupees 3 per unit. Correct? Revised contribution will become 3 per unit. Naturally, decrease in selling price will decrease the contribution per unit. And 3 divided by 9, contribution upon sales price, you will get PV ratio. So your PV ratio will become 1/3, that is 33.33%. Are you getting it? So we'll show the calculations. In the particulars, write down decrease of 10% in sales price. Decrease of 10% in sales price. Your PV ratio, I will show the calculation also. It will become 3 by 9 into 100. It will become 3 by 9 into 100. That is 33.33%. 33.33%. Or 1/3 you can say, exactly 1/3. Now how will get BEP? Fixed cost upon PV ratio, and PV ratio has changed. So fixed cost 34,000 divided by 33.33%. 34,000 divided by 33.33%. Actually exact answer is rupees 1,02,000, but on calculator you may get it in fraction also. If you are using fractional percent, you will get in fraction. If you use exact integer like 34,000 divided by 1/3, divided by 1/3 means 34,000 into 3 by 1. So you will get the exact answer then. If you use this, if you use 33.33%, you will get slight fractional answer. So you have to round it off. It is exactly 1,02,000. Done so far? Now margin of safety. Wait a minute. Your number of units sold were given in the question. How much? 15,000 units. Have they told you to change the number of units? No. So don't change the sales volume. Keep it 15,000 units. Wait. Don't write. But now these 15,000 units will be sold at the rate of rupees 9. Earlier they were sold at the rate of 10. So your total sales will also change. Are you getting it? Number of units I am keeping same because we are not allowed to change the number of units given in the question. We have to just change the sales price. So 10 rupees sales price will reduce to 9 rupees. So sales revenue will also reduce. Total sales will also reduce. Because earlier total sales was 1,50,000 rupees, but that was at 10 rupees selling price. And now minus your BP 1,02,000. That is how you will get margin of safety. Is it okay? So you have to write like this. 15,000 into 9 will be your revised sales revenue. Minus BP 1,02,000. So your revised margin of safety is 33,000. So you got all the three answers revised. Now from here you have to understand the relationship, and that is what your CVP analysis is, cost volume profit analysis. See, if you reduce the sales price, now writing work is over, try to understand it. Reduction in sales price will cause reduction in PV ratio because contribution will reduce, PV ratio will reduce. If PV ratio reduces, means if your profit margin reduces, then your BP will go up because you have to take more efforts to recover the fixed cost. So if PV ratio goes down, BP will go up. Try to understand this relationship. If PV ratio goes down, profitability margin goes down, you have to take more efforts to achieve the break-even point, means more efforts are required to recover the fixed cost. So BP will go up. And if BP goes up, margin of safety will always come down, no? Whenever BP goes up, safety margin will come down. That is logical. Because out of total part, if BP is this much, remaining is margin of safety. Margin of safety is the remaining portion after deducting BP. So BP goes up, margin of safety goes down. Second situation, write down in particulars. Another situation is increase of 10% in variable cost. Increase of 10% in variable cost. Now we will change only one thing, only variable cost. Rest everything is same now. Rest everything is same means keep the sales price same at 10. Don't make two changes at a time. But variable cost, which was earlier 6 rupees, variable cost, it will go up by 10%. So it will become 6.6, correct? And 10 rupees minus 6.6, your contribution will become 3.4, correct? contribution will become 3.4 and 3.4 divided by selling price. The PV ratio will become 34%. Okay. So PV ratio will be 3.4 divided by 10. That is what I was saying. Make only one change at a time. 3.4 divided by 10 into 100. That is 34%. Do the remaining calculation now. PV ratio becoming 34%. What will happen to BEP? PV ratio, if you compare with original PV ratio was 40%. From 40%, PV ratio has come down. So your BP will go up as compared to original answer, I am saying. I am comparing second answer with original answer. Every answer will compare with original answer. So as compared to original answer, your BP will go up. And if BP goes up, MOS will come down as compared to original answer. You can also finish it off. You need not wait for me to put the answer on screen. You can also do it. You can also do it. So 34,000 divided by 34%. It's rupees 1 lakh. And margin of safety. Now your sales will remain 1,50,000. How it will remain 1,50,000? The number of units sold are 15,000. Selling price is also same, that is 10 rupees. So total sales is 1,50,000, but BP sales has gone up. BP sales has become 1 lakh. Therefore safety margin will come down. Safety margin is now 50,000 rupees as compared to original answer. Similarly, we have to make two more changes and calculate the revised answers. Even you can do it. If you are not confident, do it on rough paper. If you are very confident, directly do it in fair in your notebook. And if your fair notebook and rough notebook looks same, means there is no difference between fair and rough notebook, then you can do it anywhere you like. Right? That choice is yours. Because majority students have fair notebook different and rough different. Okay. Third change. Increase in sales volume by 2,000 units. Increase in sales volume, that is quantity sold, has gone up by 2,000 units. Increase in sales volume by 2,000 units. Rest everything will remain same. Rest everything will remain same means your sales price will remain same. Don't change it. Don't change it. Your variable cost will remain same. Your contribution will remain same. Don't change here. Because some students do what? What they do, they say, sir, sales rupees 1,50,000 given in the question, divided by 17,000 units, because sales quantity has gone up by 2,000. Earlier it was 15,000. Don't do this. This will cause change in sales price. So you have indirectly changed the sales price. Don't do that. Keep everything else the same and just increase the quantity sold by 2,000 units. So from 15,000 units, it will become 17,000 units. Right? As this is same, your PV ratio will remain the same, my dear friends. So it will be same, 4 upon 10 into 100, that is 40%. PV ratio will remain unchanged as compared to original one. If PV ratio is same, no change, total fixed cost is same, your BP will also remain the same. So BP is same, your 34,000 divided by 40%. It is 85,000 originally, it will remain the same. So your BP is 85,000. However, margin of safety will change. Margin of safety will increase because your sales has increased. Now your sales is 17,000 units at the rate of 10 rupees and minus this 85,000 BP. Are you getting it? Your sales has gone up. Like if your actual score in the exam from 70 marks it becomes 80 marks, naturally your safety margin will go up if your actual score goes up from 70 to 80. So 17,000 units into 10 is your revised total sales minus BEP sales, and remaining is margin of safety sales, that is 85,000. And now we go to the fourth situation. Fourth situation is increase of rupees 6,000 in fixed cost. Increase of rupees 6,000 in fixed cost. Now only increase fixed cost, rest everything same. If rest everything is same, I think PV ratio will remain the same. So PV ratio will be same, that is 40%. But you would have imagined and you would have must have calculated also, as fixed cost goes up, BP will go up because you will require more efforts to recover higher fixed cost. Earlier fixed cost was 34,000, it will go up by 6,000, means it will become 40,000. So 40,000 divided by 40%. Your BP will be 40,000 divided by 40%. That is 1 lakh rupees. So fixed cost goes up, BP will go up. If BP goes up, margin of safety will come down. Correct? Safety margin will come down. Now keep the original sales 1,50,000 because we are making only one change at a time. 1,50,000 but minus 1 lakh. So your margin of safety becomes rupees 50,000. Done, my dear friends? I hope you are able to revise intermediate, right? Intermediate little bit logic, right? These are intermediate level questions. So it will give you the stimulation to your mind, right? Just to recall what you had done, and if you had not studied correctly in the correct way or not studied logically earlier, in case of CA intermediate, now you can put it right so that we can move to the journey of CA final. Because without the strong base of intermediate, I cannot take you to CA final level. And that is why I told you that in my regular batch is like a test match. It's going to be a detailed discussion. I'll have to go to intermediate level. I'll have to sometimes touch the CA final old syllabus also to take you to the upper ladder, to take you to the CA final of new syllabus, that is SCM and PE syllabus, my dear friends. Friends, today I won't go further. Actually, naturally, next question is number 3. But what I would suggest you, that you may try this question 3 to question 11. If you get time, you may try these questions at home on rough paper, right? On rough paper. Just to test whether you are able to get the correct answer. Because in any way, I am going to give you the fair answer. But you can just have a try at home, just on calculator or on rough paper. You may not write everything in detail. You don't have to write the formulas. Neither you have to prepare the tables, right? Don't do that. Just read the question carefully. Read the question carefully and try it on rough paper, right? From question 3 to 11. Because today I am stopping here, right? For today, I'll stop here. From tomorrow, I will start from question 3. And tomorrow, in any case, I will try to cover all this 3 to 11. If possible, I will even touch the CA final level. I will go to the next concept also tomorrow if time permits. Okay. So this is for you to do the trial at home, right? Provided you have time and willingness to do. So for today, it is enough, my dear friends. See you tomorrow. Bye bye.